And kick off the session. I'm Chris Fry. I'm chairing this session. I'm a member of the board. I also had the pleasure of working with these folks on some of the early design ideas for the M6, and so it's a real honor to be here introducing the group today. So we have Evangelos and Fotios and Ross all here in person, and you can see there's actually a much bigger team that's been the organizing committee of the M6, including Spiliotis, who unfortunately was not able to be here in person this time with us, as well as others. So I won't take up any more of your time. I want to move right into our great speakers. So without further ado, Fotios will be first.
Hello, everyone. So first of all, Spiliotis sends his apologies for not being here with us today. He was about to do what I'm doing now, the presentation of the overview of the competition, of the M6 competition, and then Evangelos will discuss about the 10 hypotheses that we made prior to the competition and how this came out, given our analysis of the data. And then Ross will finish off with some further analysis and some modeling aspects given competition data. So the M6 competition, for those who don't know what M means, M stands for Makridakis, of course, and is the sixth, effectively, competition in the Makridakis series. The last three competitions have run in the last, let's say, 5 or 6 years, whereas the previous three competitions were quite older. So this competition is a financial competition, so it's the first of its kind in the financial forecasting. And basically what we try to do here, for the first time in the M series, we are trying to heavily link forecasts with decisions. And we have asked the participants to submit both forecasts for different assets we are forecasting, but also how they would invest given these assets. And this has been conducted in a live manner, meaning that we didn't collect any data ourselves. The participants had to collect their data. We didn't have to do any anonymization of the data or any masking of the data, so this was all on the participants. We ran multiple evaluation rounds. Basically, the competition ran for almost a year. We had 12 rounds, and each round was 28 or 20 trading days ahead forecasting for each of the 12 rounds. So this involves real data. It's a real exercise, open access data that anybody could download, and of course they could apply models, but or they could apply some judgment. So here we're trying to see how can improve the forecasts of financial assets, and also have introduced an aspect of uncertainty here. But how can use these forecasts to build robust portfolios, investment portfolios? So the setup is we have 100 assets, 50 of them are stocks, S&P 500 stocks, and 50 of them are ETFs. And we have carefully selected these so they represent the different number of assets out there. So, as I said, we ran 12 evaluation rounds, and in each round, the participants have to submit forecasts and decisions, investment decisions, for each one of these 100 assets. They didn't get to choose. I'm going to only submit these 10. They have to submit forecasts and decisions for each of these 100 assets. The forecast duration is 4 weeks or 20 trading days. And at each submission point, the participants were also able to complete a questionnaire where we collected some qualitative data when it comes to how they forecast. Somebody to be eligible for the global prizes must be, they must have submissions for all 12 months, obviously. And for somebody to be eligible for the quarterly prizes, they must have submissions for each month of the respective quarter. However, in the cases that somebody didn't make submissions a particular month, then we assume that the submission was carried over in the next month, both forecasts and investment decisions. So even if a participant submitted only in the very first month, effectively they participated the entirety of the competition by not changing the forecasts or decisions. Okay? When it comes to forecasts and how we measured forecast accuracy or forecast performance, if you wish, we asked the participants to give us 5 numbers for each of the assets, and these 5 numbers were basically 5 probabilities which must sum into 1. And these probabilities refer to the probability of that asset to be in the first quintile, second quintile, or fifth quintile, which is the best quintile, across all 100 assets when it comes to the relative performance return of each asset. And then we measured the performance, the forecasting performance, using the RPS, the rank probability score. For the investment decision, we asked the participants to submit for each asset one number, and this number is basically the investment weight for that asset. So the investment weights could be positive, for long positions could be negative, for short positions could be 0, but at least all the weights together, there should be at least of 0.25 for a submission to be valid, meaning that the participants need to take some risk. And of course, the maximum weight could be 1. We measure the performance of the investment decisions using the IR, the information ratio, which is basically the returns adjusted for the risk. And we also measure the overall performance of the participants. In this dual competition, have these two aspects. We have the forecasting track and the investment track, but then we combine these two together. So basically, we take the ranks of the RPS and the ranks for the IR, and we take the average of this, and this is the overall rank for somebody, for the, let's say, for the global ranking, if you wish. As I said, participants were able to submit forecasts and change their forecasts and decisions every month. But many of the participants didn't do that. Many of the participants submit forecasts initially and then they forgot about it. Some of them updated every few months. Some of them updated every month. They had a variety of participants working in different ways. Overall, we had 318 participants from 50 different countries, and this formed in total 226 teams. Some of them joined the competition late, so only 163 of these were included in the global leaderboard. Now, on average, each of these teams made 5 submissions in the course of the competition. Okay? So they changed their forecast and decisions on average almost 5 times. And you can see there in the first graph on the left the histogram of how often they made submissions. It's a quick overview of the RPS score and the evolution of RPS during the competition over the 12 months of the competition. And basically here, you can see with red line the benchmark, which is for the RPS, the benchmark is that an asset has an equal probability to be in the first quintile, second quintile, third quintile, and so on and so forth. So basically, for each asset, we have values of 0.2 everywhere. That's our benchmark, for which the RPS score is 0.16, but here we present everything relatively to the benchmark. So benchmark is 0, and values above 0 are improvement over the benchmark. Values below 0 are deterioration over the benchmark. And what happens here, we can see that only a small percentage of the teams, only 23% of the teams, that's 38 teams, managed to outperform the benchmark. And then only the global improvements were very minimal, as you can see, in the top part of
Hey.
Oh no. There you go. This one? That one. So as you can see, above the red line there is whoever was better than the benchmark, and by how much is basically the distance, and the improvement is basically on average only 2.2%. Very small improvement over the benchmark when it comes to forecasting. And only 13 teams were better than the benchmark in all 4 quarters, and only 3 teams were better than the benchmark in all 12 months. So that's a very small amount of teams. On the other hand, the same graph for IR now, for the investment part, you can see here a huge difference between the previous graph and this graph. So here you can see that a lot of teams did much better than the benchmark. Now, percentage-wise, not so many more teams, it's only 29% of the teams did better than the benchmark. But when they did better, they did much better, up to 72 times better. But only one team managed to outperform the benchmark all 4 quarters, and none of the teams managed to outperform the benchmark all 12 months. So basically, in the forecasting part, the performance was more consistent, especially when performance was good. Whereas in the investment part, there was a lot of fluctuation performance, sometimes way better than the benchmark, but a lot of the times worse as well. So here is the number of teams that outperform the benchmark in N months or M quarters. So in the two left graphs there with the blue, it's for the months, for the RPS on top and the IR on the bottom. So basically what we can see is that if we focus on the 5 months, that many teams, 9 teams, outperform RPS for 5 months, and so on and so forth. This is how you can read this graph. Whereas none of the teams outperform the benchmark of IR over all 12 months. Okay? And the respective thing for the quarters on the right-hand side. So that is an overview of the competition and how we set it up and how we have the valuation metrics done. And now we have the 10 hypotheses, which, as I said, we set beforehand. And Evangelos now will present you the results from this hypothesis.
Hi, everyone. I'll try to discuss the results of the 10 hypotheses we made. We started from the hypothesis about the efficient market. We basically predicted that this will hold for the great majority of the teams. So this means that just a very small number of teams will manage to perform exceptionally well and beat the market. So the natural thing to do here is to draw some histograms presenting the distribution of the information ratio or just the returns, if you like, and you can see with the blue line here the performance of the benchmarks. The benchmark here for the investment part is just going long with equal weight. So we have 100 assets, so it's a weight of 0.01 for each asset. And at the end of the competition, the cumulative, let's say, returns was slightly greater than 0. So you can see that most of the teams did worse than the benchmarks. There were some teams that managed to do quite better than this, but there's clearly a very small amount of teams that are exceptionally better. So this stands both for the information ratio and the returns. Additionally, here you can see another graph where we have basically ranked the teams, for instance, top 20% of the teams, top 60% of the teams, and so on, and we aggregate the performance of the teams, and this also clearly shows us that basically there's a very small proportion of the teams that manage to consistently outperform the market. Now the second hypothesis was about the team rankings. We basically predicted that the selection of the loss function, if you like, would be critical about the decisions that the teams would make, and that the ranks would have changed significantly if we decided to rank them based on information ratio or just the returns or the volatility. So here I use the same setup. So we aggregate results for the top 20%, 40%, and so on of the teams. And here you can see that there is a strong correlation when it comes to information ratio and returns. It's very close to 1 when we get, let's say, more than half of the teams in the estimation. But you can also see that when it comes to the top performing teams, the correlation is not perfect. It drops to around even 50%. Okay, and we can also see that there's very little correlation between the risk and the information ratio, and accordingly the risk and the returns. It might even becomes negative for some proportion of the team. So this clearly tells us that the selection of the criterion to be used for the evaluation would have changed things, and that the ranks would be different. Now, here is also a first try, let's say, to create something like a risk curve. We basically plot the returns versus the risk, and naturally you would expect, let's say, the greater the risk to become, to have even very great gains or very great losses, but here you can clearly see that in some cases the risk that was taken did not really justify the returns. So this may also justify why there's no correlation between the returns and the risk. The third hypothesis has two parts. The first part is about a weak link between the ability of the teams to accurately forecast the individual rankings of the assets and the risk-adjusted returns on investments. And we also hypothesize that the magnitude of this link will increase in tandem with the team's rankings on average. So here you can see a first graph. We have a simple core plot between the information ratio and the RPS, and you can clearly see that when it comes to including all the teams, there's absolutely no correlation. Basically, you can see that even the top performing teams, which have in the second part of the competition, they have an information ratio of like 30, have almost the same accuracy as those that did terribly bad. So when you observe the complete data set, there's no correlation. So what we did next in the graph on the right, you can see what happens if you try to rank the teams based on three different criteria. The first one would be the information ratio, the second one would be the RPS, and the purple line would be the combination of those two. And here there's an interesting finding. You can basically see that those that did better in terms of forecast have a negative correlation when it comes to returns. Those that did good in the investment part, they were mostly uncorrelated with the RPS, and even the top performing teams had a negative correlation. And the strong correlation is only identified for the teams that did good in both parts of the competition, and basically in those, let's say, the top 20 or 30% of the teams. So this is, if you like, an indication that since this was a duathlon competition, some teams that were good at forecasting decided just to provide some good forecast, let's say, but they did not do that good in the investment part of the competition, and the other way around. So this is why there's not that much connection, and you have to basically focus on the teams that put some effort in both competitions in order to start identifying some connection there. The second part of the hypothesis is about how concentrated and risky the submissions would be, and if this could be justified based on the accuracy, and the answer again is no. You can see here that we have created, apart from the risk measure, which is the denominator of the information ratio, we have also computed the average number of invested assets, because more assets imply less risk, and also the absolute investment weight put per assets, because we expect, if you invest all of your money in just one or two assets to have a more risky portfolio. And here you can see that also if you use these, let's say, indicators instead of the risk to identify correlation between RPS and the risk taken, there is no actual correlation. Okay, so
Evangelos, could you go one step back? The top left one, is that jittered? Because I have a hard time understanding that people would take 98 or 99 securities. Or are all these ones on the right-hand side, are these all 100 and it's just jittered?
Or 98, let's say. Yes. Yeah. So most of the teams invested in all the assets.
So there's just jittering in here, and it should really be just a vertical line. Mm-hmm. Makes more sense. Okay, thank you. Sorry.
Hypothesis number 4, high-performing teams in the investment challenge will build the portfolio using assets that they can forecast more accurately. Okay, this is a logical hypothesis that you try to invest in things that you are better at forecasting. So what we did here is that we investigated the submissions made and basically tried to measure the forecasting accuracy per asset instead of the complete data set. So the assets that had an accuracy of smaller than 0.1 were considered let's say, good forecast and assets that were predicted with an accuracy higher than 0.2 bad forecast. And we grouped the submissions in that sense in order to see what's happening and correlate it with the investment weight. And here is the top 15 methods in terms of information ratio. And you can see that basically they put almost the same weight in assets that they actually forecast good or bad. Now, things get a little bit more interesting if we focus on the teams that had had established a connection between their forecast and their investment. So we did an analysis to find which teams had, let's say, the highest connection between the forecast and the decisions. And here we can see that things are slightly better. We can see that they tend to put more weights on the assets that they can forecast better. But again, you can see that there is a lot of overlapping between the box plots, so there's no evidence that they actually followed our hypothesis, and things remain the same even if you focus on the things that they're not very strongly, the decisions are not very strongly connected with the forecast. And this is another classifications. We basically use the questionnaire that Fotios told you about. So what they stated that they had stated that their forecast would be connected with their investment. So this hypothesis is rejected. Now, hypothesis number 5 predicted that teams will be measurably overconfident in the accuracy of their forecast on average, and that forecast will be less dispersed and have smaller variance than observed in the data. Now, in order to address this hypothesis, we have focused on 3 different groups of submissions: those that did better than the naive strategy, those that did worse, and finally the top teams. And these are some calibration graphs, if you like, because they basically tell you what was the actual probability of something to happen and what was the prediction. And here you can see that there's a bias. Okay, basically they tend to put higher, lower probabilities in what's going to happen, and after 0.4 or 0.5 probability, the forecasts are basically completely uncalibrated. And this is the good case, because these are, after all, the teams that we did better than the naive strategy. Now here you can see that for those teams, they basically submitted something that is very close to the benchmark. So there's no calibration here, and they just assume that there's always a probability close to 0.2 for all the assets. And this is for the top 10 teams. We can see that this bias at the very beginning is better than in that case. But again, after some point, the calibration is not that good. But I should mention that there were very, very, very few teams that put a probability higher than 0.4. So this is mostly due to the lack of data. Okay, so we should probably focus from 0.4 and below. And this was all actually, after analyzing the data, a main reason why these teams managed to do better, because they just avoided taking high risk of saying this asset has a probability of 100% being in that particular rank. But on average, the calibration is bad and the performance is not that good. Fotios told you that the best forecast was actually 2.2% better than the benchmark in terms of forecasts. Hypothesis number 6 is about the magnitude of improvement, if you like, when it comes to information ratio and RPS. So basically here you can see the improvement over the benchmark. And I think this hypothesis is accepted, because you can see that a very small proportion of the teams managed to do better than the average. And things get even worse if you compare with the benchmark, because the benchmark is better than the average of the teams, you can actually see that just 11 teams managed to do better in both tracks of the competition, both the forecasting part and the investment part. And this is an interesting hypothesis. It has to do about averaging forecast rankings, and basically tells us that if we aggregated multiple the submissions made by different teams, the results would be better. And these are the results for the RPS, and these are the results for the information ratio. With the purple line, you can see the best performing team. This is the benchmark, and this is the median of all the submissions. And with these dotted lines here, we basically have, let's say, the aggregates of the team. So here we aggregate the top 20% of the teams, or the top 60% of the teams, and so on. And you can see that if you start aggregating the top 20% and above, the submissions get much better than the winning submission. And things are a lot better for the information ratio. Okay, so if you could identify, let's say, 10 to 12 teams that submit their submissions added value, and you could aggregate these results, the performance in both tracks would be significantly better. Hypothesis number 8, teams that employ consistent strategies throughout the competition will perform better than those that change the strategies significantly throughout the competition. Okay, so here we assume that consistency would be a good tool in order to improve performance. So in order to deal with this hypothesis, we, let's say, try to introduce some ways of to describe, let's say, the key characteristics of the strategy. The first one would be the exposure, the amount of investment. Fotios told you that a minimum of 25% investment was required, up to 100%. So this is part of a strategy. The second one is the number of assets that you decide to invest in. Investment weight range, okay, so which is the maximum difference, let's say, between the weights you use. And finally, the investment direction, because some teams decided to go just for long positions, other for short positions, and so on. And here you can see the performance. If you try to classify, let's say, the teams in terms of exposure, of diversion, or for investment direction, and so on. And you can see that although there's some small differences, there's not some there's no clear evidence that one strategy did better than the other. Now here you see the results aggregated for each of the components of the strategies. Now in this slide we basically measure how many times the strategy changed over time. So imagine that you start from a low exposure and low diversification strategy, and then you move to a high exposure and low diversification, let's say, strategy. Okay, so here we measure how many different kind of strategies were used, and you can see that although on average the more strategies are used, the worse your performance is in terms of information ratio, the correlation is not that significant. So we say that this is a controversial finding because there is some trend, but it's probably insignificant. Now the 9th and the 10th hypotheses are about the methods used throughout the competition. And we try to deal with this hypothesis based on the questionnaire that they were submitted by the participants. Hypothesis number 9 tells us that submissions based on pure judgment or that rely heavily on judgment will perform worse than those based on data. So we expect the statistical model or a machine learning model or a combination of models to do better than pure judgment. And here you can see that pure judgment, so the first table is about the absolute scores, and this is about the ranks. Okay, the story is pretty similar. Here you can see the average of the results, and this is what happens for the ninth quantile. And you can see that pure judgment does not do that were significantly inferior to those based on data-driven approaches. But we can also see that when we had a statistical forecast and we try to inject some judgment in that forecast, this sometimes was beneficial. Okay. And finally, we have hypothesis number 10. The top performing teams in the forecasting challenge will employ more sophisticated methods compared to the top performing teams in the investment challenge. In order to deal with this hypothesis, we try to focus on the top 5, 10, 15, and 20% of the teams in terms of RPS and IR, and measure based on the types of methods they used as stated in the questionnaire. Try to measure, let's say, how many of the teams were time series based or machine learning based and so on. And you can see that although time series methods and machine learning based methods are more in numbers, their differences are not that great in order to clearly say that, for instance, ML based methods did better or time series methods were based. So this hypothesis
These are numbers
is also
or percentage of the given category.
this is the
Counts.
top
These are counts.
counts. So one team,
But these groups were not equal. I mean, the judgment based has, for example, 9 teams, so 3 is 35% of this group.
yes, they're not the number of the judgmental forecasts are not the same. Yeah. But we just focus on that we think the top 5%, top 5% teams, how many used a method like that? Okay, so I understand what you're trying to say, but it's more about what the winners did. So if we want to learn something from the winners, what that would be. So Rose can take over and show you some meta-analysis.
Right, so quite a lot of the analysis we've seen is just using quite simple metrics of the portfolios and the forecast. So what we've tried to do here is to do something a little bit more sophisticated and employ an approach which is quite common amongst practitioners doing this kind of stuff in real life, as it were. So in order to do that, we decided we'd build a risk model for the competition, so we can do a risk analysis of the submissions, the portfolio submissions, so we can break down the volatility, forecast volatility, where that volatility comes from. Does it come from stocks? Is it factors? And can it attribute the risk to different places? So in order to do this, we decided that we kind of try and keep it relatively simple. You can obviously go to quite ridiculous lengths to do these kind of things, and then within the big investment firms, people will have they'll have teams of people doing this stuff all the time. So it's a big effort. It's forecasting risk. So we've kept it relatively simple. We try to keep the data relatively readily available. So I mean, you can go to quite serious extremes to do this. You can use tick data every few seconds to measure volatility, and that gives you better results in the literature. Maybe two or three months out. Quite surprisingly, we didn't do that. So we just used data that we could download from Yahoo. So we've got high, low, open, and close prices. So we use that. And computationally, we've tried to keep it relatively straightforward as well. So we're not, you're not having servers close to the exchange and all that kind of stuff that some of these guys do in practice. And we wanted our model to incorporate kind of relatively well understood and known about stylized facts of investment returns. So changing volatility over time, certain factors that are known to be quite predictive in terms of asset returns. We wanted to get those in there. So basically what we used the ETF returns, which span a vast different range of market assets. So we've got everything from the S&P 500 in there. We've got European stocks, Asian stocks, bonds of different terms, long-term bonds, cash. So from those ETF returns, we were able to define some factors which hopefully capture most of the different kind of undercurrents of markets that are going on. And by doing that, we just get the data from Yahoo. We can build our factor model with all that data. We haven't got to get data from anywhere else. So we think this is something that people could have gone to the effort of doing for the competition itself. So I think it's quite a realistic thing that could have been done. And the methods we've used are all relatively well documented, kind of state-of-the-art models from different academics that are kind of readily available. So there's no kind of rocket science in here. So why do we use a risk model? Well, for the competition, we were asking people to maximise the ratio of portfolio return to portfolio risk. So obviously, on the forecast side of the competition, we have our return rankings, which incorporate a kind of distributional aspect because we're assessing them using the RPS, and we'll touch a bit more upon that in a minute. But we also need an expression for the volatility of our portfolios. Okay, so that's where the risk model comes in. If people have built this, they could have used the risk model, the risk assessments from this to put back into their forecasts. We haven't really explored that too much yet. This is all quite relatively recent work, and there's more to come in terms of how we can use the information that we've put together here. So the return forecasts come from the forecasting competition. We need a model for the volatility. The good news is the volatility component is generally much easier to forecast than the location of the assets. Okay, it's much easier to forecast the volatility of markets and stocks than it is to forecast their returns. Returns in financial markets, the characteristics are the returns are very small relative to the volatility. Volatility is much easier to forecast return. So it's actually quite surprising when you think about it that, judging by the results of the competition, hardly anybody bothered to do this. So this was the easiest part to do, and very, very few participants bothered to do it. Okay, that's quite interesting. So how can we use the model once we built it? We can analyse the submissions. We can build some optimised portfolios, which I'll show you the results of in a minute. And there's plenty more that we can do as well. So some of the analysis that we've heard about already this afternoon, we can have another look at that analysis through the lens of the risk model, and maybe narrow down on some more detail on in terms of that analysis. So how do we do it? Relatively standard procedure, which we've tweaked a little bit to fit with our objectives. So the kind of standard way of doing this in finance is to break the variance forecasting process down into two pieces. So to use univariate volatility forecasts for each asset, and then to standardise the returns that are generated, and then use those standardised returns to construct a correlation model, okay, which you can make time varying. So for the univariate part, we've used a model based on Spiliotis' Risk Everywhere paper, which is I think 2016, and that uses a model based on Nicosia's HAR model, which is very similar to a Midas regression model. The beauty of this one is you can fit it with OLS, so it's really easy to fit. You can fit it in R or Python or even Excel if you want to. It's an easy one to do. The Spiliotis paper uses tick data, so realised volatility based on tick data. We haven't gone to the expense of collecting that, so we've just used range-based volatility estimators. There was a little strand of literature around about 2000 focusing on how you can use high-low open close prices to get a better picture of daily volatility than just using the close-to-close. So those metrics are quite effective. So we use those as our daily proxy for volatility. and then we basically build on those into the risk everywhere model. It's also interesting because it's got a global risk factor in it, so it looks at risk spillovers. So it calculates the changes in volatility across all the assets, and then factors that back down to an asset level. So, if you see a big explosion in volatility in the S&P 500, it's highly likely that will spill over into other asset classes. So this one takes account of that as well. So using that model, we build two forecasts. We build a daily forecast and then a 20-day forecast. And the 20-day one we actually use to look at the competition results corresponding with the time horizon in the competition. And then the 1 day ahead, we use those to standardize the realized returns and then to build our correlation model on those standardized returns. Okay, so the correlation model is Engel's dynamic conditional correlation model, which is pretty standard now. It's been used for quite a long time. It's basically a very simple multivariate Garch model. You just use two parameters to smooth the covariance matrix. One big difference. So Engel uses what he calls correlation targeting, which is common in Garch models. So the first long-term element in your Garch process is this kind of long-term steady state correlation. We instead of doing that, we use the smooth. We have a kind of smoothed version of that, which assumes a single index model. So we take as our single index the average of all the assets. I mean, you could number of different things you could use for that. You could use the S&P 500. You could use some kind of market cap weighted estimate, but obviously that all involves different data. So just to keep it simple, you just take an equally weighted combination of all the assets as our central single factor model, and we shrink our covariance estimates to the long-term single factor model covariance structure, and then we basically optimize the hyperparameters, but only on a grid. So to do these optimizations, if you want to do quasi-maximum likelihood for these kind of things, it's incredibly computationally intensive. So Engel developed a shortcut way of doing it. But we wanted to optimize out of sample forecasting, so we basically just chose numbers from a grid. And the numbers that we come up with basically imply a very significant amount of shrinkage towards the long-term single factor model, which kind of corresponds with, certainly with my experience, that you have to do a lot of shrinkage in these models. And if you're a kind of frequentist type person and you just want to do sample covariance, you just get blown away. So, it's certainly one of those areas where a little knowledge can be a very dangerous thing. If you use Markowitz type optimization without a properly shrunk covariance matrix, you're in a whole world of pain. So, how do we do in terms of our model? So, what we've got here is the model forecast volatility and then the actual realized volatility. So, obviously, we've got quite a lot of portfolios here from all the different submissions, all the different submission points. And I think in general we've done a pretty reasonable job. So you can see the model's pretty unbiased, a pretty direct 45-degree angle between the forecast and the outcome, emphasising some of the extreme risk portfolios that people have submitted. Kind of call this the ice cream cone chart, but there's some quite extreme risk up here, and this comes back into the next slide. So when we look at the optimizations, one of the main reasons that the optimizations have done an awful lot better than the participants did is they just take much less risk. So it comes back to one of the earlier slides where we basically predicted that people would take far more risk than they had any kind of rational basis for doing, and that's exactly what happened. And you can see it in some of these dots out here. Very, very high levels of volatility in the portfolio. So, Spiros asked me to explain how to do the optimization. So this is one for Spiros. Hi, Spiros. So basically, it's a pretty standard optimization, but what's really, really important is you get the calibration right. Going back to our point on shrinkage and on the variance forecasts, if you get them wrong, it's meaningless. Okay, so you can dress these things up and make them look very, very sophisticated, but seriously garbage in, garbage out. So how do we do it? There's a pretty standard recipe for doing this. So we scale the asset scores. So we have the probability scores for each asset in each quintile. We just multiply those by a vector of 0 to 4, which gives us a score for each asset. So a scalar score for each asset. We standardise those cross-sectionally. So we basically get their deviation away from the average. On average, the score is 0. We use what we call an information coefficient, so an IC, which is basically the cross-sectional correlation between the score and the return. So this is a different performance measurement criteria from the RPS score that we've used. And one of the things that's starting to come out from here is that this IC that we use is basically focuses on the location of the score, whereas the RPS looks at the distribution. So what we're starting to see is that, as with quite a lot of finance research, you see a difference between statistical significance and economic significance. So what we're starting to think of, well, the IC is measuring the economic significance that we can, how much value can we extract from these forecasts. It doesn't tell us much, the IC doesn't really tell you much about the distribution. Okay, so maybe the RPS is capturing the statistical evidence, but the IC is capturing the investment relevant evidence. And as we'll see, that's quite a difference. So effectively, we assume that before we see the scores, our expected return on all the stocks is the same, or all the assets is the same. You could make different assumptions on that. You could basically look at a beta and imply a CAPM type model. Didn't go to that trouble, so we just assume that before we see the scores, all the assets have the same expected return of 0. We've got our volatility forecast from the risk model, and we basically scale these scores by the volatility and the IC. It's basically a linear Bayes update of 0 prior expected return given we see the scores. Pretty standard way of doing things. Going back to Grenell Khan's work in 99 and actually to several academic papers a lot earlier than that. So that's basically how you scale your alphas. And then the optimization step. So a standard Markowitz portfolio optimization has a utility function, quadratic utility function, like this one. Problem with that is it needs a risk aversion parameter to plug into it. So we designed M6 so you didn't need to do that. So we basically tweaked the objective function so you can take the risk aversion out. So we don't have to make an assumption of what the risk aversion is. So we just ask people to maximise the Sharpe ratio. The ratio of the return. The plus on that is that we don't need to worry about risk aversion. The minus of it is a non-standard mathematical form. But still actually quite easy to optimise, especially these days when you can chuck it in RR, or again even Excel. You can do it in Excel. So we use sequential least squares with a auto-differentiated function to optimise the utility function. So that's what we did. So what we took the scores submitted by all the participants, and then we basically just ran them all through the optimizer with different sets of assumptions. So we used a low, medium, and a high IC, 0.05, 0.1, 0.15, and this is what we got. So basically what we see is that the participants who had the most negative IC, their performance is made a lot worse by the optimization process. And the guys who had the positive IC, their performance is made fairly better by the optimization process. So the optimization process is doing a much better job than the participants did of turning the IC, so the quality of the forecast, into a portfolio. So if you like, the implementation using the optimizer is much, much better. So that's obviously great if you've got a good IC, not so great if you've got a bad IC. So if you've got a bad IC, you want inefficient implementation, okay? Because you want to cushion the effect of your negative IC. But it also goes to show that basically if you're just producing noise or you're producing worse than noise in terms of your forecasting, then obviously that comes through into your portfolio. So we can see that we've done a reasonably good job of translating positive realised IC into positively performing portfolios. And I think, as I said, there'll be a fair bit more to come out of this exercise as we can basically paint much more interesting pictures with the risk model than just by counting assets or counting net exposure. It's a bit more sophistication. Thank you very much.
Before any questions, I should say that there is a conference coming up in November, 6th and 7th of November in New York, where it's a combination of a practitioner conference that the IAF organizes usually with the results of M6 conference. So it's organized by IAF and the University of Nicosia. So, you have it there? Have it there, yes. The Future of Forecasting and the M6 Competition Conference, November 6th and 7th in New York City. So if you want to participate, attend, you can check out the webpage in the Makridakis Open Forecasting Center for more details. Any questions?
We have about 10 minutes for questions.
Okay, wonderful. Thank you very much. Very interesting talk. So first off, I assume the special issue is not about the M5 competition because that's already out. All right, sorry about that. No, actually, I was wondering, did any of the teams disclose their affiliation? I see that the diamond sponsor was JP Morgan. Were there any investment banks or anything else disclosing that they actually participated? And failing that, any thoughts on any potential selection biases? So if you're an investment bank and you have a really good model that actually outperforms everything in here, you'd probably not participate in here because what's in it for you? Our publication, you don't want that. So any thoughts on that?
Well, we had pretty good prizes, but past that, I think the top performers of the competition were not big investment companies or anything like that. Evangelos has more details about the participants.
There were some teams from funds, JP Morgan included. There were some tech teams from like 5 participants per team that were from big R&D labs from big tech companies. That some of them, especially the investment part of the competition, did particularly well. And there were some individual investors. I googled them, their names, and I found that they actually do this for a living. There were lots of academics, of course, but I think it was quite diverse, and that we can see that some people that are experiencing doing this thing actually had a good position also in the competition.
And one difference from previous competitions is that we didn't require people to disclose what they were doing for exactly the reason that you. So that we kind of tried to get around that first one. As for JP Morgan, they're probably still using stuff I read about again.
But I should say that they were the winning teams were surprisingly willing to share a lot of information. So we believe that for not the M5 special issue, for the M6, we'll have some input there about what the winners did to win. Hopefully we will. Yes?
But did you you showed the results of aggregated, but you have 50 stocks and 50 ETFs. Did you separate these results only on stocks, only ETFs?
No, we haven't done.
Which are the winners on the ETF? Because
Working on that one.
sorry, was it?
We're working on that one.
Oh, okay.
That will be definitely interesting.
Yes, different.
Did you consider doing any type of permutation testing to see if the results you got, like the distribution of returns, would be significantly different than if like decisions were just made randomly?
Basically, the benchmark is something close to random. It's equal probabilities.
Right, but if you have like 150 different teams making their own like different decisions, you're going to see a distribution of returns, right? I just wondered if you'd done any permutation testing to see if. Okay.
And there are also other benchmarks, right? I mean, our benchmark takes 100% risk, 0.01 weighting probability, and it takes long positions. So another benchmark would be only on short positions, for instance. So there are some benchmarks that we follow. And we're also thinking about the forecast dimension, that the 0.2 probability on each quintile is a benchmark to start with. But what other benchmarks do you have there? How about, for instance, forecasting the values of the assets and then translating these forecasts into quintiles?
I mean, if you think about it, given we've got such a mix of assets, actually 0.2 doesn't make a huge amount of sense because you've got a T-bill ETF, which has got a very small standard deviation, and you've got some individual stocks which have got very high standard deviations. So, 0.2 is pretty naive, so there's a question as to whether you could make a more informed choice based on the volatility of the asset.
It's true. Our plan is to have some additional benchmarks, maybe like Fotios said, forecasting the prices, or even we will have some classification model, because basically we have five classes there and we can predict their probability, and maybe this will make the results even more intuitive.
There is much analysis to be done, a lot. I will present a fuller set of analysis in the next M6 conference, and also there Malvina and Chris are also going to make some discussion about the results. And we're going to have the three top performing teams presenting their results there in the conference, but also, as with the previous group, we have a special issue in Nigeria, with us writing one of the papers about the results and analyze the results in every single aspect before we actually make the data competition available to all of you, so you can analyze it even further if you wish.
So we only have about 3 minutes left. Here, go ahead.
So first, I totally agree with the previous comment about I think it's a very important test to perform. But there's the same with your hypothesis with aggregation, right? So you use this heuristic starting from the top, right? But then it's the same. We know that in terms of combination aggregation, you should account for covariance, right? Or similarities. So here, by using this kind of heuristic, we don't know how robust it is, right? So you should do some kind of Monte Carlo in the way you pick the guys you put in your aggregation and try to see how it may affect the picture or not.
There's a lot more that we can do.
Yeah, that's what I mean. So that's the first thing I would think of. But this hypothesis is a bit tricky to talk about if you only use this one heuristic, right?
I agree. I totally agree. But at the same time, it's interesting how good this works even when the complete set is almost, let's say, 70% of the set is included in the aggregation, because I expect it to work better, let's say, when you're in the top 5 or 10, but it works pretty well even when you're...
I would keep this result, but I mean, you need some additional ones, right?
Completely.
Okay, last question.
So I'm wondering, I mean, in a real world situation, you would only care about the value that you get, right? And the forecast accuracy wouldn't matter at all. So now in this competition, because you care about both, I'm wondering how much does this kind of draw it away from what people would do in the real world?
I mean, you can't really do this without forecasting. The whole point of value added in investment management. So whether you realise that or whether you make mistakes, a lot of people don't make explicit forecasting, they are forecasting because they're making decisions. If you're making a decision, you make a decision to hold one asset. Okay, so that there's an implicit forecast in there, and that forecast is basically telling you you're not being very rational because you're forgoing a massive amount of diversification by taking that decision. So when you even if you're not making an explicit forecast, if you're assuming a degree of rationality are investing. So yeah, most of the successful people doing this on the quant hedge fund side are doing this very explicitly. Warren Buffett does it much more implicitly. if you analyse Buffett's returns, you attribute his returns to three different factors.
Please join me in thanking the presenters. Really.
Please remember this last comment.
Yeah, I mean, reject.
Yeah, I know.